Whenever I'm at conferences or events or just checking my social media, I get the same question. Are you worried about the economy and how it might affect real estate? That's why in today's episode, I decided to ask 5 experts what they think about a possible recession, tariffs, and other economic forces that could affect real estate. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Joining me today are Devon Kennard, Mauricio Rauld, Jay Scott, Ashley Wilson, and Brian Burke, who all share their insights on where they think the economy is heading and what it could mean for investors. I do want to make a quick note that I recorded this live at a conference, so you'll hear a lot of background noise. And if you want to see the video of this interview, just go to our YouTube channel, RealWealth. Joining us is Brian Burke, a multifamily investor and the CEO of Praxis Capital. Over his career, he's managed large portfolios, and he's become one of the most respected voices in real estate investing.
Well, the jobs report came out. It wasn't great. A lot of people think that the economy is slowing. There's uncertainty with the tariffs. Are you concerned about the economy?
Not really. I mean, I think that there's a good chance that we're going to see a recession of some sort that will probably look different than past recessions have looked. But am I concerned about it? No. I think it's going to negatively impact a lot of investors, but that's going to create opportunity. And, you know, I've always done better in bad economies and down markets. So I don't want to say that I'm rooting for that to happen. But
I did see a smile on your face.
But you did see a smile. Because if it does happen, I know how to deal with that.
Yeah.
I've been through it before several times.
And you're set up better this time.
I'm set up better this time. We've got, you know, all the tools in the toolbox to take advantage of that kind of an economy. And that causes me not to worry much. And I think that what I already own is set up to withstand economic dislocation. So I don't feel like it's going to be a big problem for us.
Okay, so we both went through the Great Recession
Didn't
of
we ever?
2009. So we did learn a lot. And the way that we both were set up back then versus now, what's the difference? Because once you've gone through that, you don't want to do it again. So what did you do differently this time? Because people have been predicting a recession pretty much every year for 15 years since that. And I think both of us were working hard to set ourselves up so that we never have to go through that kind of pain again.
Yeah, you know, it's interesting. People talk about the value of experience and having market cycle experience. And some people kind of dismiss it like, you know, you don't need that. I've been doing real estate for 10 years, right? And the market's been great for 10 years. So they don't have that cycle experience. But the part that they're lacking is they're lacking those injuries and scars that don't heal quickly, where you're like, I never want to experience that again. It was way too stressful. It was way too much work. So I think the main takeaway was to structure your investment portfolio in a way that's resilient against economic dislocation. You know, you avoid things like too high of leverage and short loan maturities and risky asset classes and extending yourself out too far. And the things that caused a lot of people to suffer during that last crisis. And you don't repeat those same mistakes again. I think that's probably the most important takeaway.
Yeah, a lot of people are experiencing that today in multifamily because of short-term loans, because of being over-leveraged. I guarantee, even if they failed and lost, those who get back up on their feet are going to do it very differently and much more carefully.
There is no question about that. So we had a number of apartment complexes that we sold right before the market collapsed in 2022. And I've now had, count them up, 4 of those properties that we've sold where the brokers or owners have come to us asking if we wanted to buy them for the amount of the loan taken out by the buyer that bought it from us. And when I said no, now some of these properties are coming back, and I've actually been told we could buy it for the price that we paid when we bought it the first time. You know, it's a really tough place to be in. And why are those people in that position? Well, they're in that position for a couple of reasons. One is they paid way too much. The other is they got expensive financing with high interest rates. And the third is that they had a short loan maturity, and now their lender is knocking on their door and telling them you've got to do something, and it puts them in a really stressful spot. So avoiding those kinds of things is what avoids most of the headaches in this business, I think.
Well, if you're going to be passing on some of those deals, maybe just send them my way.
Send them your way. Okay. Well, I'll give you a secret. You probably don't want to own them.
Oh, okay. Never mind. All right.
Up next, Jay Scott, a partner at Bar Down Investments. He's a multifamily investor, successful house flipper, and a go-to voice on the U.S. housing market and the economy.
All right. Well, there's a lot of people who've been predicting a recession for about 15 years since the last recession, pretty much. There is a lot changing today. Are you worried about a recession?
So I guess there's two questions there.
Yeah.
One, do I think there's a recession coming, and am I worried about it? Do I think the recession's coming? Yes, obviously. You could ask me that question anytime in my life, anytime in history, before or moving forward. And yes, there's a recession coming. The economy's cyclical. There's always a recession coming. We don't know if it's going to be 2 months from now, 2 years from now, 10 years from now, but at some point the recession's coming. And
That's a good answer.
Yeah. And so just to put things into context, over the last 160 years, we've had 36 recessions. So if you do the math, 160 divided by 36, you'll find that on average, we have recessions every 4 to 5 years. Now, over the last couple decades, the time has kind of stretched out. And the last time we had a recession, a real recession, was 2008. So that's been a really long time since the last one. But typically we have recessions every 4, 5, maybe 6 years. And so investors who were investing before 2008, we just got accustomed.
That was just part of the deal.
It was just part of the deal.
Mm-hmm.
And so I guess the question now becomes, am I worried about a recession? I'm not really worried about a recession for a couple reasons. Number one, if you know it's coming, and again, we don't know that it's going to happen this year or the next 4 years or the next 10 years, but if you know it's coming at some point, now's the opportunity to learn about what that means, how it's likely to affect us as investors, and how we can pivot when we start to see the signs that it is coming. So, for example, one of the risks with recessions is that lending tends to tighten up. It becomes harder to get loans. It becomes harder to refinance. And so one of the things we need to do if we think a recession is coming up is we need to avoid short-term debt. Because we don't want to get into a situation like a lot of us in the multifamily space got into back in 21, 22, 23, where we took out 2, 3, 4 year term debt. And then we got to the point where we had to refinance. Interest rates were up and values were down. And we couldn't do that. Exactly.
I didn't do it in the 2020s because I did it in 2008.
Exactly.
All you just do it once, then you won't do it again.
100%. We learn.
Yes.
And so instead of learning ourselves the hard way, it's important to do some research and to study and to read and learn about what you can expect. And so one good strategy, if you think the recession is coming up again, avoid short-term debt, avoid debt that's potentially floating rate, meaning if interest rates go up, the cost of that loan is going to go up, things like that.
Also known as adjustable rate. So any balloon notes, anything that has to be paid back at a certain date. Obviously, a 30-year has to be paid back, but you've got 30 years to do it, and it's fixed.
By the time you're paid off, there's no loan left.
Yeah, exactly.
So am I worried about a recession? No, but I do recognize that it's likely going to force me to start thinking about things differently, treating my business differently, treating debt differently, being more cautious about the tenants I bring in. So when you have tenants that are likely or more likely to lose their jobs, if you have tenants who are more likely to have worse credit because credit tends to go down during recessionary periods, we have to be more diligent about doing tenant checks and making sure they're good tenants and making sure that they're not going to get in a situation where they stop paying and they're hard to evict. And so there are a lot of things that we have to do differently. But when you accept the fact that recessions are just part of the natural cycle, you stop worrying about them. Another thing to mention is that depending on the asset class you're in, if you're investing in single family versus multifamily versus self-storage versus office, whatever it is, each of these goes in different cycles. And so we might be getting into an economic recession where inflation might be coming down and jobs are coming down. And that might be bad for the single family market, but that could be really good for multifamily because interest rates coming down makes loans cheaper. Sometimes it brings cap rates down, which means values go up. And so keep in mind that a recession isn't going to affect every asset class, every investor, every location equally. And so when you think about, are we heading into a recession, the next thing you have to think about is, how is a recession likely to impact the specific types of investments I'm doing today? Because the answer for me might be different than for you, different for Krista, different for everybody.
Well, and I can tell you, I went through one of the worst recessions. The Great Recession was the worst since the Great Depression. And our strategy was to help investors own rental properties that cash flow in Texas. Texas had and still has the highest job growth, population growth, and infrastructure growth in the country. And yet it was still pretty affordable compared to other areas, like $140,000 for a brand new house in Texas that rented for $1,500. We helped hundreds of people buy those. The recession happened, and guess what? People still chose to live indoors. There was actually more rental demand as people went into foreclosure. They needed to rent, and our members did not feel that recession at all.
Yep.
So we already know if you know the storm is coming and you know how to prepare yourself and you have plenty of reserves, you're in the right loan structure, you're in the right market, you're going to be just fine.
Yeah, and here's the thing. I had properties back in 2008 that I might have bought for, values were different back then, but I may have bought them for $100,000. And then after that massive downturn, they were only worth $60,000.
Yeah.
A lot of people would be terrified and think, oh my God, I lost my investment.
money. Yeah.
But you didn't lose your money.
Because you didn't sell.
As long as you had a tenant in there who was paying the rent that could cover all the expenses and you didn't have to sell, the value from 100 to 60 or down to 20 or up to 200, it doesn't matter. It's just a number until you actually need to sell. So the key is putting yourself in a position where you don't ever have to sell.
Yes.
Again, long-term loans, fixed rate debt.
Plenty of reserves.
Plenty of reserves, finding great tenants, picking the right locations.
Yep.
If you do that, you can weather a storm because you're not going to be forced to sell.
Yeah, love that.
Our next guest is Mauricio Rauld. He's a nationally recognized securities attorney and the founder of the Premier Law Group. Mauricio specializes in helping investors and syndicators navigate the complex legal side of raising capital for real estate deals.
All right, Mauricio, big, tough question here. Are you concerned about tariffs?
In the housing market, I'm not necessarily concerned. I do think it's going to affect the housing market big time. I'm personally not concerned, but here's what I think what's going to happen is tariff is going to impact the sort of the raw materials, right? Lumber, aluminum, copper, all of these things, which is going to drive up the cost of construction, right? Which means prices of real estate are going to go up. So that means two things. Number one is if you own real estate, that's great for you. Yep. Number two, if you're trying to buy real estate, it becomes less affordable for you. So it pushes you into sort of the renter nation, which forces more people to rent, which again, if you are in the business of real estate investing and you're looking for renters, you're better off if there's more renters for your product. There's more customers for your product. So I think it depends on who you are. If you're a real estate investor, I think tariffs potentially could be a good thing for you. If you're trying to buy your first home, that's challenging. Or if you're trying to upgrade to another home, it might be challenging. But as a real estate investor, if people can't afford to buy their own home because the price has gone up, they're going to become renters, which are basically your customers.
And on top of that, builders only build. They only bring on new supply if they can profit from it. And if they can't profit, they're not going to do it. So we're seeing more developments, build-to-rent communities that just never got off the ground. So those of us who are doing build-to-rent communities, putting together funds, you're writing up the PPM for our multifamily fund coming out. The people who can get into the game are going to be the winners. If they can make it work, you can pick up deals. There's opportunity because there's going to be less builders out there willing to take the risk.
And the other thing that happens, which you've seen actually going on for the last 50, 60, 70 years, is that because the cost of construction is going high, builders are having to basically build bigger and bigger homes in order to get the margins. It's much easier to build one extra room, another 150 square feet, because you don't have all the plumbing and everything. So that's one of the reasons why if you look back into the 1930s, 40s, 50s, you'll see your average home size 900 square feet or 1,200 square feet. Today, they're not McMansions, but they're getting bigger. And one of the reasons for that is the cost of construction.
Yeah, you heard it right here from Mauricio.
Our next guest is Devon Kennard. He is an NFL linebacker turned real estate investor. Devon has built an impressive portfolio while balancing his professional sports career. And he is passionate about teaching others how to create long-term wealth through real estate.
So there's a lot of interesting headline news, a lot of fear out there, concern that there might be a recession. Are you concerned?
I mean, obviously things are changing in the real estate landscape, and I don't think anyone should hide away from that. But I'm a firm believer that if you're developing and growing your skill set and your network, you're going to be able to adjust and find opportunities. So if you're stuck in one mode, that's where you can get stuck. There's people who are preaching Burr method nonstop, and it's like that doesn't work as well. And are you gonna try to make a square fit into a circle? Or are you going to be like, hey, Burr's not working as well as it used to. I'm either leaving money in the deals now, or I'm going to find a different kind of strategy. I'm going to pivot in some way. And you can do that by growing your network and by adding skill sets to yourself. You can't be a one-trick pony per se. So you have to kind of perfect one thing. So maybe Burr method was your thing, but now can you stack on something that works in today's market? So I think that's key. And I like that mindset because I can take control of that. When you're looking at the outside and the economy and interest rates and all that, I don't want to be watching the ticker every day and it's dictating my entire life, my entire investment horizon. What are the things that I can control? And that's the skill set and how I pivot and the network I have around me that provides me opportunities and allows me to continue to grow.
So one pivot you made was from the cash flow to more growth opportunities.
Mm-hmm.
What now? What's your pivot now?
Yeah, so my pivot now, I retired from the NFL. So now I'm in a place had a higher earning job and I was investing in net worth growth, buying single family, buying and investing in syndications. Now I've pivoted to where I want to get my cash flow levels high again because I don't have consistent earned income. And I'm really growing my lending company and I'm lending to investors and developers in the Phoenix market. And that's kind of my cash cow that sustains my lifestyle, but also allows me enough money to continue to buy. Because, once I retire, there's a certain point where if I don't have enough income coming in, I'm not going to be able to continue to buy assets and grow. So I'm like, how can I generate enough income to sustain my lifestyle without spending down principal, but also keep reinvesting? So I'm in a place now where it's like cash flow matters a lot to me, but by investing for net worth and growing my balance sheet for all those years, now I'm able to detract that. Now I'm refinancing a lot, pulling equity out of that, putting it into assets that are cash flowing more. So my lending business, and then now is generating that income.
Brilliant. What would you say are some of the risks that are out there that people can't see? And let's say specifically in your field, because you have now been working with a lot of other NFL players who typically make a lot of money but don't realize that is going to end, right? And they will be maybe retired earlier than other people.
Yeah, I think, one, in the athlete space, you don't know how long you're going to be playing in the NFL. So really kind of balancing out. I see a lot of guys investing too much in things that are speculative, and that should be a very small percentage of your portfolio. You need more consistency. You worked your butt off to get to the level where you're making that kind of income. Now invest in things that, it doesn't have to be 100% guaranteed, but are more conservative and are definitely going, not like, I got to wait 10 years and it's a venture capital deal and it's boom or bust. So that's one of the first things I tell guys is be conservative. Real estate is always a good place to place your money because you get tax benefits, appreciation, cash flow, you get it all instead of private equity, venture capital. The return seems so sexy, but if you're putting all your eggs in that basket and they don't hit, then you're in a place of struggle. So that's something that I teach. And then in the real estate space in general, I'm seeing a lot of people buying deals that the margins aren't really there and they're doing them anyways. That can get tough because in my market in Arizona, if you're trying to flip a property or build a new development and the margins are kind of thin, if the holding costs add up, if it's staying longer, and then the holding costs for your debt. So now you're in a position where prices are going down and debt, your holding costs are going up. So that margin is shrinking. And, I think I'm starting to see a lot of people with not enough margins in their deal and not enough conservative underwriting. So now's the time to be conservative in your underwriting. And if you can make some money and you're going to be okay in the worst case scenario, maybe that's something to do. But if it's like, I can make $40,000 or I might lose $20,000, I don't think those are bets people should be making right now.
We're also joined by Ashley Wilson, founder of Bar Down Investments. She's a multifamily investor and syndicator with extensive experience leading large apartment projects and educating others on how to succeed in real estate. All
right. There's a lot of scary headline news out there. There's a lot of changes. People are freaking out. Are you concerned about a recession or investing in today's environment?
I think in every change in market cycle, opportunities emerge. I think we are standing on the cusp of the biggest technological revolution in real estate than we've ever had in history. And not a lot of people are really hyper focused on this.
Yes.
But because there are so many inefficiencies in the industry as a whole, it doesn't matter what asset class, it provides a lot of opportunities for tech to come out, especially now that we have AI. How is AI going to really change the landscape everywhere from, if you look at multifamily, for example, everywhere from leasing to operational management to construction. I mean, even think about 3D printing of how houses and now multifamily units. I mean,
Yeah.
it's a huge game changer. So I think that as humans, we naturally shift whenever any challenge comes before us, because it also provides an opportunity as well to find a new solution that is most likely better than what we're doing today.
100%. And one thing I say is AI is going to take over a lot of jobs, but you know what I don't think they're going to do is become landlords.
No. I think even AI doesn't want to become a landlord.
Yeah, I think our jobs are protected.
Couldn't agree with you more. I think the other thing with AI is a lot of people are focused on, okay, the AI is going to replace jobs 100%. But I also think it's going to shift jobs, because right now there's a need now for people who prompt AI and prompt different codes or commands. But I think eventually that'll change as well. So things will become more efficient. I think paralegals, that is probably like a dying breed too, but that doesn't mean that they're just going to go away altogether. There's still monitoring checks and balances. And then there's also probably a shift on other things that we don't even know are needed yet. But there's always kind of like a chain reaction of new opportunities that emerge because of something that is just a game changer to how we operate today.
All you have to do is look at the Industrial Revolution, and people were freaking out about change then, and look what happened.
Exactly. It's just a shift.
Yeah. Love it.
Thank you so much for joining us here on the Real Wealth Show. If you want more content that's economics and news based, make sure to check out our other podcast, Real Estate News for Investors. We'll have it linked in the show notes. On this podcast, we cover the latest news stories that are impacting the housing market and real estate investors. Thanks for listening. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.